Hello and welcome to Pro Trader Strategies Market Commentary for Friday, August the 3rd. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with Unenjoyment Friday. That's what we used to call it on the floor when the non-farm payrolls number came out, because it was always one of those crazy mornings. Anyway, so let's get on with it with some economic data from across the pond. We got services PMI out of Great Britain. That came in at 53.5, lower than the expected 54.7. Remember, these PMI numbers are based on anything above 50 is expansion in the economy. Anything that goes below 50 is contraction in the economy. All right, so PMI for that Great Britain, obviously above expansion territory in a sense. A little bit lower than what was expected. And then retail sales out of Europe came in at 0.3%, expected to be 0.4%, albeit they did revise last month's number up from unchanged to positive 0.3%. So that revision kind of makes up a little bit for the deficit we saw of 0.1%, making that number overall number look a little bit better. And then we got here in the United States, average hourly earnings came in at 0.3%, expected to be 0.3%, and they revised last month's number down from 0.2% to 0.1%. Remember, we want to see earnings increasing, especially if we're going to start seeing prices paid go up due to these tariffs. We need to be able to offset that pricing power, if you will. We need to have earnings offset rising prices in order for this to be a really healthy economy. And then we got non-farm payrolls, which was what, of course, the media is talking about today. And it came in at 157,000, expected to be 191. So we completely missed on that one. So everything's horrible. No, not really. Think about it. We talk about the revisions. Last month's number came out at 213,000. They revised that up to 248,000. So we got an extra 35,000 hires that we didn't really realize last month. That is going to overall affect the overall number, and that makes this number not look so bad at all. We also got the unemployment rate coming in at 3.9%, expected to be 3.9%, but we've gotten below 4. That's huge for the overall economy. And then finally, we got final services PMI came in at 58.0, and we got ISM non-manufacturing PMI, which is really the one that we look at, and non-manufacturing is just another way of saying services, and that came in at 55.7, expected to be 58.6. All right, now that we got all that out of the way, let's get it on with the overall markets. Crude oil slightly off a little bit today, back down below 70 still. We tried to go up and bust through that 50 fib that I talked about, which coincided with the 50 simple moving average, all of those things, and the 9-day moving average gonna kind of act as a little bit of resistance here, and we're falling down and away from that point of control. Just being below this, it is going to want to draw like a moth to a light to the fire. It wants to go back down to that points of control where these high nodes are. And then we've got gold futures moving higher today by about $7. I'm not really quite sure what the catalyst for this is, other than it has been the lagger as everybody has been rushing to the dollar. Everybody's been hollering about the dollar. Gold has been the lagger there. So I've talked about this many times. I think it's going to hold to 1,200. That's just going to be a major area where anybody who is long gold is going to defend till the cows come home, basically. So we've got gold moving higher today. Bonds, they're moving higher only because we've had a sell-off here last several days. I think that this is just a market reaction from intraday trading, finally getting tired of having these shorts, and whenever it gets consolidated like that and you're short, the last thing you want to do is be the last guy trying to cover that trade. So a lot of times we get these bases built, and we can see it fall off as the weak hands get out, if you will. All right, so bonds moving higher, but they don't have, again, much room to move to the upside. And VIX continues to slide, although it's off of its lows. Hopefully we're kind of creating a bottom here. Anytime we're getting down here and it starts going to single digits, it starts to hopefully pick back up as people get a little bit complacent. We've got the Dow Jones Industrial Average up almost 65, a little over 65 points today. It was in negative territory earlier on this morning, but we are starting to push up and away. NASDAQ still in negative territory. It was leading the push to the upside yesterday, especially with Tesla missing on earnings and still blasting higher. But today, a little bit of profit taking going on from some of those tech stocks and seeing the NASDAQ down just slightly on the day. E-mini S&Ps just slightly positive on the day. So we could almost say that all of these are pretty much unchanged, other than maybe the Dow Jones being up 50, 60 points. That's a decent move to the upside, but for a one or two up or down for the NASDAQ and the E-mini S&Ps, that can be made up in a matter of seconds. And this is the daily chart the 30-minute chart of the E-mini S&Ps. Each one of these blue segments is a day session with the night session added in, obviously. But you can see yesterday's rally almost unabated after the open, and I talked about this. It was basically slamming out all these overnight inventories being short and got them on their heels and rallied this market like crazy to the upside. Again, with that being said, usually on Fridays in the summer, I say that there's going to be a melt up going into the latter part of the day. But we might not see this after yesterday's massive rally going in. That could have been a lot of retailers as the overall big money goes on vacation for the weekend. We could see some of these retailers start to cover some of those longs and maybe even see a little bit of a rollover. But, it's kind of a toss-up. That's just my feeling right now as I look at the overall markets. All right, Google. Now, Google, jumped on this really early this morning. I was looking through a bunch of things, trying to find something where I could sell premium. I was looking at Google, and Google has a tendency to get a little bit of vol crush after its earnings event, and then has a tendency to maybe trade sideways to down, and then it's just kind of a slow trudge to the downside to low implied volatility. I saw that happen. We got the crush. We got a little bit of a bounce. It seemed to me this morning this might be a time to be able to sell a little bit of premium, even though I'm bending some of my rules on selling premium below 50 IV percentile with Google, but it was right around 46 or something like that when I did this trade. So it's a yellow light, if you will, but I decided to go in there and sell some puts anyway. So I did the September with like 49 days to expiration and sold the 1,100 puts in there for $5. So those 1,100 puts gets me way down here with a $5, gets me below that gets me below this 200-day moving average. All right, so that's what I was looking for that trade there. And then over into eBay, which has been a bit of a thorn in my side. Remember, I did this for an earnings trade. I sold the 36 puts in there. Now, when the earnings came out, obviously did not look good. And I got assigned those puts, or somebody put the stock to me. So I am long eBay at $36. But when I sold those 36 puts, I sold them for 44 cents. So that lowers my break even slightly down to the 36 puts. So 35.56 is where my break even is originally on the onset of that trade. Now, as soon as I got to the earnings, realized I was going to be assigned that stock, I immediately went out and sold some calls against that because implied volatility hadn't completely come out of it yet, and started working on my covered call strategy, knowing I was going to be assigned most likely those that stock in eBay. So I sold the 36 calls originally for 33 cents. That was right after the earnings event. Now those calls obviously have decayed almost nothing. I had to roll out to try and collect more credit. Rolling out to the 36 calls just wasn't enough premium for me to really make that move happen. So I rolled it actually down to the 35 calls and out to the September. So rolled my August 36 calls out and down to the 35 calls in September and collected another 40 cents for that. So all in all, My total credits to date right now are, I'm going to have to add this up in my head. So 84 cents plus 33 cents. We've got somewhere just over $1, almost $1.20, right? So if the market came back up, I still have covered that deficit going from the 36 to the 35. I have collected enough credits that I am, if the market comes back up and blows through me, I still have enough credits to cover that deficit because I'm long at 36, short the calls at 35. That's inverted. But because I've collected over $1 in credits, it could still be a positive trade if the market spiked back up to 35 in the next 40 some odd days. So I'd be okay with that. I'd still have a winning trade on. So in the future, I might roll those out and up again. So continue to play with those, lower my overall basis of what I paid for this trade. And right now, I'm just below $35 in eBay. Long eBay at 35, let's call it. All right. And that's about it for today. Hope everybody got a lot out of yesterday's webinar. It was on bond protection, and that is one of the parts of our portfolio that is the most neglected. And I think right now it is imperative that we start paying more attention to that bond side of the portfolio. So go to protraderstrategies.com, sign up for that webinar. It could be one of the more important webinars you watch this year. Okay? So that's about it for today, other than if you can't take that, take it easy.